Most investors know ETFs are low cost and easy to invest in. But do you know how much tax you'll pay on your profits? Today, we'll break down ETF taxation rules in India with simple examples so you never get surprised by a tax bill. Types of ETFs in India. Remember first that ETF taxation depends on type of ETF because each is treated differently under Income Tax Act. Equity ETFs track equity indices like Nifty 50, Sensex, Bank Nifty. Debt ETFs track bonds, government securities. Gold and silver ETFs track physical gold, silver. International ETFs track foreign indices like Nasdaq 100, S&P 500. Commodity ETFs example oil, silver. Taxation rules equity ETFs. Equity ETFs is equal to taxed like equity mutual funds. Short-term capital gain, STCG. If sold within 12 months, tax is equal to 15% flat on gains. For example, buy Nifty ETF at 100 rupees, sell in 6 months at 120 rupees, profit 20 rupees, tax is equal to 3 rupees, 15%. Long-term capital gain, LTCG. If sold after 12 months, tax is equal to 10% on gains above 1 lakh rupees in a financial year. For example, you invest 5 lakhs rupees in Nifty ETF, after 2 years value is 6 lakhs 20,000 rupees, profit is equal to 1 lakh 20,000 rupees, first 1 lakh rupee exempt, taxable is equal to 20,000 rupees, tax is equal to 2,000 rupees. Taxation rules for debt ETFs, bond ETFs, PSU debt ETFs, etc. Debt ETFs are treated like debt mutual funds. STCG. If holding period less than 3 years, gains taxed as per your income tax slab. For example, buy 1 lakh rupees, sell in 2 years at 1 lakh 20,000 rupees, profit 20,000 rupees if in 30% slab tax is equal to 6,000 rupees. LTCG. If holding greater than 3 years, 20% with indexation benefit. For example, buy at 1 lakh rupees, sell after 4 years at 1 lakh 40,000 rupees. Suppose inflation index makes purchase price is equal to 1 lakh 10,000 rupees, indexed gain is equal to 30,000 rupees, tax is equal to 6,000 rupees, 20%. Taxation rules for gold and silver ETFs. These are treated like debt mutual funds, non-equity. STCG. Less than 3 years added to income, taxed as per slab. LTCG. Greater than 3 years 20% with indexation. For example, gold ETF bought at 2 lakhs rupees, sold after 5 years at 3 lakhs rupees. Indexed purchase price is equal to 2 lakhs 40,000 rupees. Gain is equal to 60,000 rupees. Tax is equal to 12,000 rupees. International ETFs, US, global. These are treated as debt funds, even if they invest in foreign equities. Same rules applied. STCG. Less than 3 years as per slab. LTCG. Greater than 3 years 20% with indexation. For example, invest 1 lakh rupees in Nasdaq ETF, sell after 4 years at 1 lakh 60,000 rupees. Index cost is equal to 1 lakh 20,000 rupees, gain 40,000 rupees, tax 8,000 rupees. Dividend taxation. Earlier DDT, dividend distribution tax, existed. Now, dividends are added to your income and taxed as per slab. For example, you receive 10,000 rupee dividend from an ETF, you're in 20% tax slab, tax 2,000 rupees. Advance tax and TDS rules. No TDS on capital gains from ETFs. If total tax liability is greater than 10,000 rupees in a year, you must pay advance tax. Practical tips. Equity ETFs are most tax efficient if held greater than 1 year. For debt and gold ETFs, hold for greater than 3 years to enjoy indexation. Use growth option instead of dividend for better tax efficiency. Always maintain purchase and redemption records for tax filing. So now you know how ETF taxation works in India. If you found this useful, hit like, share with your investor friends, and subscribe for more ETF and investing insights.